Hello and welcome to Portfolio Matters Week 41 weekly update. And again, it has been an extraordinary week in commodity markets. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Let's start the week's program, Keith.
Okay, thank you, Richard. Okay, first of all, some housekeeping. Well, we now have a GoFundMe account, and anyone wishing to contribute to the podcast would be very, very welcome to do so. And we'd like to thank William B, Simon W, and Rob M for their amazing generosity during the week. Obviously, donating is entirely voluntary, and we are amazed by the generosity of some of our viewers. Thank you very much. It encourages us and keeps us going. Okay, so there wasn't really much economic news this week, but there was a blizzard of economic data. So in the UK, we had earnings for August, and they came in at 7.2% year on year for average earnings, including bonuses. That was down on July, but beat expectations. Excluding bonuses, it was 6%, which is still high, but again, down on July and matching expectations. The UK unemployment rate continues to fall. It's down to 4.5% in August. That was down from July and below expectations, which is good. UK GDP growth was 6.9% in August, substantially down from July's number, but beating expectations. Industrial production in August was plus 0.8%, which was well up on July and massively beat expectations, which is good. That, of course, is before all the supply chain disruptions and rising energy prices really kicked in the UK. Now, in the US, job openings in the US for August were 10.4 million, which is substantially down on July, actually, and below expectations, although the jobs market remains strong in the US. And that may be indications that the US job market is healing and people are getting jobs. US consumer inflation expectations rose to 5.3% for the coming year in September, and that is up from August and matched expectations. So US consumers are expecting elevated inflation for the coming year. Now, non-farm payrolls for September, and that's the big number on the week, came in at a disappointing 194,000, and that was down on August and massively beat expectations. And the market has taken that very well because that seems to push back the dangers of the Fed raising rates. But as we will see, that number has been artificially depressed by a reduction in government payrolls during the month. Okay, so the US unemployment rate continued to fall and fell to 4.8%, down from 5.2% in August. So that's a big drop and well below expectations. Now, the US participation rate is not recovering, and it actually fell again in September to 61.6%. Down from August and massively down on expectations. And it appears that workers who left the US labor force during the pandemic are reluctant to re-enter. And the US inflation rate for September came in at 5.4%, up from August and beating expectations. And the core inflation rate was at 4%. Reminder, the Fed's target is 2%. Now, we had some flash numbers. So in the EU, the flash economic sentiment indicator came in at 21, which is a massive drop from September. And unsurprisingly, supply chain disruptions and the energy crisis are affecting business confidence. Now, in China, the Caixin Composite for October showed a decent bounce, which is very encouraging. 51.4, which was well up on 47.2 in September and beat expectations. Now, we also had some Chinese export and import numbers, and these are interesting. So in September, Chinese exports rose 28% year on year, which is up from August and beat expectations, whereas imports were up only 17.6%, which was well down on August and below expectations. So the Chinese are exporting more than expected and importing less. So that is good for China and not very good for the rest of the world. So let's go through some charts. So this is UK GDP, and the numbers have been revised. So the blue line is the old data and the red line is the new data. So GDP growth in August was disappointing, but the new numbers show overall GDP growth has been stronger than previously expected. And in the UK, payrolls are back to their pre-pandemic levels.
It's interesting that payrolls are back to their pre-pandemic levels, actually, because we're suffering a severe shortage of particularly Eastern European labour, we're told. So it's quite difficult to square those two and to wonder where the additional employment has come from. UK average earnings, including bonuses, has been going up sharply, a little bit of a tick down, but the trend is sharply up and significantly higher than it has been for the last 10 years. US job openings have, as we know, rebounded dramatically, and they now seem to be falling off a little bit. We'll have to wait and see whether that's the start of a trend change or whether it's a little bit of a blip due to the removal of pandemic payments, support payments, and so forth. US non-farm payrolls are US non-farm payrolls are worse than expected, as Keith mentioned in his data summary. And US consumer inflation expectations have ramped up remarkably, and this suggests that the economy is there are some economic indicators in the US which suggest that things aren't all that well underneath the hood, as it were, with the non-farm payrolls worse than expected and this dramatically higher consumer inflation expectation figure. And we do quite a lot on inflation further on during this talk, so we'll move on to that, I'm sure. The US unemployment rate is continuing to trend down gently, which actually contradicts the non-farm payrolls data, doesn't it, Keith?
Yeah, but I think it's also a question of the participation rate. So, yes, you know, what we're seeing is people are just not re-entering the labor force, which is very inflationary. We'll go through this in some detail.
And US continuing jobless claims are also dropping back down towards, but not at yet, pre-pandemic levels. As Keith says, the US labor force participation rate dropped from around about 63 pre-pandemic, and it seems to have stabilized at around about 61.5, which is a more than 2% reduction in the labor force participation rate, which, you know, it's basically saying 2% of the working population of the US has dropped out of the workforce, which is a huge and rapid change. And there we have the US inflation rate. So what's going on? We've got a weaker than expected unemployment figure, much higher inflation expectations, fewer people in the workforce, a higher than expected a few months ago inflation rate, and tightening supplies all over the place. The Fed is saying they don't want to raise interest rates. They're going to taper very, very slowly. And I think I can understand where they're coming from with some of this data, in that there's a mix of data, some of which is saying the economy is booming and some of which says the economy is in trouble. What do you think, Keith?
The Fed's actions, I mean, the Fed is still doing QE. Interest rates are at absolutely rock bottom. You have strong wage growth, rising inflation expectations. Essentially, demand for goods and energy is more than supply. So if you want to reduce inflation, you have to reduce demand, which means raising interest rates. But central banks are trapped. If they raise interest rates because of the huge amounts of debt, their danger is they reduce demand very quickly. So currently, their actions are showing that they prefer growth to financial stability, really, in the form of keeping inflation low. They prefer to let inflation run hot than to endanger the recovery. Okay, so this is the October flash, actually, of European businesses' economic sentiment, and you can see it's declining really quite rapidly, unsurprisingly, given the energy situation and supply chain difficulties. But good news in China, the Caixin Composite Purchasing Managers Index has had a bounce, which is slightly against expectations given the ongoing energy crisis in China. And we will show you that Chinese coal prices rose by 30% this week. And also we have developing difficulties in the property sector. So one thing that I've instigated this week is a summary of where we are in inflation terms, because inflation is picking up. And so this table, which you may want to pause if you're interested and look at, summarizes inflation in the major economies. And you see everywhere, apart from Japan, where it remains absolutely subdued, it is well above the 2% central bank targets. Now, we had an exchange on our Discord channel with Hydra 4J, who sent us an interview with a German economist, and he was pointing out that actually German CPI, half of the increase was due to the return of VAT levels to their pre-pandemic levels, so the rise in VAT rates. And the economist was saying he didn't think there was a problem with German inflation. Now, we disagree. We think inflation is rising absolutely everywhere. You're seeing wage rises. You're seeing strikes in the US now, as well as in Germany, over high inflation and workers wanting their wages to keep up with inflation. And yet, central banks are still pumping money into the economy through QE.
I do think this concept that we've talked about before, and that you can't get wage inflation because economies are deunionized, is a fallacy. I think if people feel that they need more money, they will either reunionize or they'll just gather together in an appropriate group within their company or their industry, and they'll strike for more money. It's interesting to see that we are starting to get, despite the fact that things are deunionized and we're not going to get strikes, we are starting to get a few pay strikes coming through, just as you mentioned.
Or what happens is people just leave the job because they're dissatisfied with it. And then at some stage, the company realizes it can't actually function and massively hikes pay. And that essentially is what happened with UK HGV drivers. Suddenly they come into work and find they've got a 40% pay rise.
So if your role is fungible, as it were, and it can move elsewhere, as the lorry drivers can, you can do that. If you're a car plant worker, basically you're either a car plant worker or you're unemployed, you can talk to your mates and you can go out on strike. So it's a non-argument for wage spiral inflation.
Now, but we've just talked about how central banks are pumping QE into the economies still. But this is a chart from Japan, and the light blue line is Bank of Japan total assets. And you can see that they have been buying government bonds, equities, everything, and massively increasing their balance sheet. And the dark blue line is Japanese consumer prices. And you see there's been very little effect. So it is true that QE does not necessarily lead through to inflation. It essentially does an asset swap. So it buys assets from banks and replaces it with cash. And unless that cash is lent out then you don't really get inflation.
Yeah, so Japan has had what's known as a balance sheet recession, where corporates and I think households were totally grossly over indebted, and they have spent the last 25 years, 30 years paying that debt down. So effectively the pull forward GDP that indebtedness creates has been given back to the future again. And of course, if you have a balance sheet recession, it can take many years to clear, and you won't get inflation because your sort of composite demand doesn't go up.
Mm.
In fact, it declines.
This is the balance sheets of the major central banks, and you'll see that in 2020 they massively increased. And this year they're still growing, but at a substantially slower rate. But everywhere we look, we are seeing inflation. Now, in Germany, these are astonishing numbers. The wholesale price inflation is 13.2%, the highest since 1974. In the US, if we look at 2-year wage inflation, so cutting out the COVID effects, you'll see that you're getting very elevated wage rises, over 10%. And 1-year inflation, it don't look much better, frankly. Seeing the fastest rise in weekly earnings since 1983, and that is a wage price spiral in action. So when the central banks talk about it being transitory, this is direct evidence that it ain't. And if US businesses carry out their plans to raise wages, and that is the light blue line, then the dark blue line, which is actual compensation, is like to rise further in the future. The dark blue line here shows the increase in wages you get if you switch jobs. And you can see it's the highest it's been in 20 years. So this goes back to Richard's point. You know, if you're unsatisfied with your wages, you can switch jobs, and companies are bidding up for work for workers, and particularly for blue collar workers. So the dark blue line is the wage growth of blue collar workers. The white line is a white collar workers, but the purple line is CPI, actually less food and energy. So wage growth is not keeping up with inflation. And actually, even at these elevated wage growth figures, you are seeing a reduction in living standards. Over half of US small businesses are saying they have vacancies they can't fill. So they're going to be bidding up for labor, basically. And businesses are planning to raise their prices. And Nordea have got this chart where they're leading these. The blue line is planned price changes, and that is pushed forward by 10 months. And then the light blue line is CPI. And so if that relationship holds, you're going to see median CPI pushing from its current 2.5% towards 4%. And as a result of all this, consumers are expecting strong inflation over the coming year. So the Fed seems to be losing control of the inflation narrative. Consumers are expecting inflation well above the Fed's target of 2%. And Richard, your point.
Yeah, I mean, it's a bizarre thing, isn't it? All items except food, shelter, energy, used cars and trucks. It's a pointless. It is, fundamentally it's meaningless. And to try and, I mean, the way that the Fed and central banks try to micromanage economies these days is extraordinary and impossible in my view, and to micromanage them on totally inaccurate, incomplete, almost falsified data. I mean, what is the point of their existence when they behave like this? I genuinely think that. So, but this is this is just it's Alice in Wonderland data, basically.
Well, the point is that if you exclude pretty much everything you don't want, you still get an unpleasant inflation picture, frankly. And this is just to reiterate, even though wage rises are elevated, the cost of goods, etc., and services has been rising faster. So people's living standards in the US have been declining. So they're going to demand higher wages.
Yes.
And the global inflation surprise index is at an all-time high.
I think I would just like to comment on that one, Keith. Who's surprised? Because you and I have been talking about this for a long time, and I don't think we are surprised by it. Whereas it's a misnomer, isn't it? It's not really a surprise. It is, oh my goodness me, look what's happening. What a surprise index. Sorry, it is.
I take it this is analysts and investment banks are surprised.
Yes, because all they do is their mantra is the status quo.
Well, they presumably have some bonds to sell as well. And when we say we're not surprised, well, have you seen the price of bonds? I mean, they're still absolutely rock bottom.
Yes.
There are some people in the bond buying departments who believe the central banks. It's amazing. But anyway, so French bond yields. It is not so long ago. It was only that's 18 months ago that French bond yields were actually negative. In fact, no, it's actually a year ago they were still negative. Amazing. So those have risen quickly. German bunds, bear in mind that German inflation is now 4%, but their 10-year bund still has a negative yield. It's heading rapidly towards zero, but guaranteed to lose you money. The stock of negative bonds is declining, and frankly, I'm just amazed it's not at zero.
Keith has done a little bit of digging into debt service ratios during the week, and this table shows the debt service ratios of non-financial corporations in European countries from 2016 to 2020, and then broken down by quarter from 2020 onwards. So the higher the debt service ratio, the more of the free cash flow a company is spending on principal repayments and interest payments. And what this table specifically highlights is that there are some companies where the non-financial corporate sector is incredibly indebted, and France stands out as being extraordinarily high with a debt service ratio of 73%. In other words, only 27% of the corporate sector's free cash flow is available for anything other than servicing their debt. And Canada comes in a healthy third at 57%, and Sweden is second at 60%. United Kingdom is 34%, which is actually one of the lowest. Germany is 27%. But what it also says is that if interest rates go up, then they don't have to go up very much for the highly indebted countries to go bust, simply. Yeah. And France is in the most dangerous position of all. And as Keith showed in the previous chart, French interest rates are rising quite sharply. And the debt service ratio has gone up from quarter 120 to quarter 121 in France from 58 to 73. So one can surmise that if the interest rate goes up by another 1.5% in France, the debt service ratio will go up to around about 90%. Not healthy. Well done for finding that, Keith. Household debt service ratios look fine, not too high.
Yeah, absolutely. So I think actually most consumers, because they were the beneficiaries of government largesse, actually managed to pay off debt. Okay, moving on to the September jobs report in the US, which was disappointing. But if you look bottom left, you'll see that the headline number of plus 194,000 jobs was depressed by the government shedding 123,000 jobs. Now, you remember that during September, we had the whole shenanigans about raising the debt ceiling. I suspect what happened was the US government tried to essentially cut jobs in order to maximize the length of time it could run given the money it had available to it. And
Yes.
so in September, total private sector job growth was 317,000, which is respectable. And if you look at the job recovery from the recession, this recession is the fastest ever recovery. But there's something we've talked about many times, is the US labor force participation rate is just not recovering. And this is really inflationary because essentially companies are finding it very difficult to find workers. And it seems that a lot of people left the labor force during COVID and are simply not coming back. And as we've talked about in previous weeklies, how much of that is older workers who have financial assets, and those assets have been bid up by central bank largesse during the crisis, and you've seen stock markets all around the world soaring. So those elderly workers can look at their savings accounts and think, I don't really have to go back into the workforce. And that means that central bank policy is having detrimental effects on the real economy. And there are plenty of US job openings. They just can't fill them. Okay, so bubbling away in the background, we have the Evergrande crisis. And as we've talked about in previous weeks, this is not something that's going to develop instantly, but it is steadily getting worse. So thank you to our Discord viewer, I'll call him Jaw-It. I don't know how to pronounce that. And who sent us this, which is a really interesting chart. This is from Goldman Sachs, and it shows the Chinese property market is the largest financial asset class in the world, bigger than the US bond market or the US equity market.
So Keith, last week I was listening to a podcast where they were saying that the Chinese property market makes up 80% of Chinese investments. And so the Chinese, and I think it's also 13% of GDP. So the Chinese dependence upon their residential property market is extraordinary.
Yeah. And we saw in the chart last week that something like, was it 85 to 90% of new properties were bought by people who already owned at least one property. So it's it's a financial asset rather than a dwelling.
Same person would also say that the reason this has happened is because China has had these very high GDP targets, annual GDP growth targets, and effectively to achieve the targets, whatever natural GDP might be, is then boosted it with property GDP, which of course works, but you are in fact creating malinvestment in property that nobody wants, which is what they've done.
Yeah. So Goldman is saying that if there's a Chinese slowdown in the Chinese property sector, it will knock between 1.5% and 4.5% of GDP. Now, historically, China's been growing at about 6%, but that is slowing. And if you had the higher number of those two, it could well be that Chinese economy does not grow next year. And thank you once again to Jaw-It for sending us this. But Chinese property developers' sales have been declining. And in September, they fell by an average of 36% year on year. So that is all indications of a developing property crisis in China. And as a result, the price of Chinese property developers' bonds are collapsing, i.e. the yields are rising. And it's not just Evergrande. So you'll see that actually in the last 2 weeks, you have had a broad sell-off in the bonds of Chinese property developers.
So another interesting thing that they were saying in this webcast was that it isn't this. Some people have been suggesting is this a Lehman type crisis, and this person's view was it's not, because most of the debt is actually in China, but also what debt there is, people know about. It's identified. Whereas with Lehman, nobody knew where the debt lay. Nobody knew where the liability lay. Now, if he's right, then he's right, if you see what I mean. But if there's a lot of shadow banking debt that we're not aware of, that's associated with the Chinese property developing potential crash, then that could spill over into the world's financial market.
That strikes me, which is very much wishful thinking.
As I was speaking it back, Keith, I was thinking, this sounds a bit bland, doesn't it?
Yeah, well, Chinese system in general is just about the most opaque in the world. And, there's loads of debt with the state-owned enterprises, and the banking sector is state-directed. I mean, they've just got no idea what's in it.
Well, I think you're right, Keith.
And so but so far, there haven't been elevated bankruptcies in the Chinese property developer sector, and contagion into the banking sector looks limited. So financials haven't, collapsed, and as a result, the Chinese central bank has not had to inject extra liquidity into the financial system. Although, frankly, this all really reminds me of 2007, when everything. Yeah, there's a bit of a problem going on in subprime, but it'll be all right.
The way I look at it, if the property market is something like 80% of Chinese household assets, and let's say the value of that drops by 30 or 40%, then, which it could easily do, given the quantity of empty properties in the system and the level of indebtedness, if there's a flush through of the system, that has hugely damaging impacts throughout the whole of the Chinese economy. And given that the Chinese economy is the second largest economy in the world, it's bound to impact the rest of the world economy.
Yeah. Watch this space.
Yeah.
Okay. Other charts. Well, a reminder: inflation surprise index continues to run hot. The economic surprise index is now pretty negative, and that is stagflation. You heard it here first. Mr. Richard Wheater, market guru.
That was back in June, I believe, Keith.
Yeah, absolutely.
Every Thursday. Well, I hope I'm wrong. No one wants stagflation. It's very unpleasant.
Yeah, well, my pushback, you will all remember, is that either you can't have stagflation because bond yields spike, and that would drive the economy into recession. And frankly, it ain't happening. Bond yields remain amazingly low.
That is because, Keith, we have central banks.
Yeah, and they retain the confidence of the market, amazingly.
Yes.
For now. Okay.
By the way, if we get shut down, if we go to pier next week, you'll know that the Bank of England will have had a word. Okay, so this is the electricity costs of a ton of steel in the EU, and you'll see it's rising quickly. And ArcelorMittal have announced a €50 a ton energy surcharge after its own costs increased by €120 a ton. So, it's only a question of time before elevated energy prices start adding to the inflation mix. And these numbers look, from the low of sort of May 2020, Keith, they look to have gone up around about fourfold to me, just by eye.
And this is the price of fertilizer, which is frankly a function of natural gas. So
I didn't realize natural gas was so important in the production of fertilizer until a few weeks ago.
Yeah, and that is food price inflation coming down the pipe. Now, this is really interesting. This is a table showing what CEOs on US Q3 earnings calls cited as a cause of negative impact on earnings. And so, number one was supply chain disruptions, which we've covered here. Number 2, labor shortages, which we've also covered. Number 3, COVID. 4, transport and freight costs. 5, raw materials. Now, right down, that is that number 9, is oil and gas prices. And you know that in Q4 earnings, that's going to be going through the roof.
Yep.
But this is really bullish. This shows the stock of unsold new houses, and it is at an all-time low. So inventory is going to need to be rebuilt, and US property developers are going to have to build a lot more new houses to satisfy demand. That's very bullish. Now, we are also seeing signs that the global supply chain disruptions may have peaked. So semiconductor shortages are now actually falling, and freight rates appear to have peaked. And the ships at anchor off Shanghai are down by nearly 50% in the last 18 days. That's a drop of from 153 container ships to 81. Now, one thing that we've talked about previously is John Dizard's point about supply chain and how you can have knock-on effects. As the supply chain becomes disrupted, end users order more because they don't know when their supply is going to arrive. And then when the supply chain disruptions ease, they find they've actually got twice as much stock as they expected, and then they cut orders. So as supply chains ease, you might see actually perversely a knock to economic growth as companies cut future orders.
That is possible, Keith, but I would suggest that the shock has been so great that any cut would be slow, and it wouldn't be, oh, great, we've had our delivery, now let's cancel those orders, or let's put. I suspect that there will be a great deal of caution if businesses have been constrained in terms of their ability to manufacture goods because of a lack of inventory. I don't think they would move quickly.
Yes, I agree with you, Richard. I also think that going forwards, companies are likely to hold more inventory closer to home than they have previously because they've learned a lesson.
The just-in-time system has been shown to actually leave businesses highly vulnerable to anything that goes wrong with the system, and it's not actually a secure method of operating your business.
Now, last week we showed you lots of graphs about the energy crisis in Europe, which seem to have peaked. Well, we're going to show you more graphs this week, which show that sadly it ain't. And this is a table that from the UK Office of National Statistics, and it shows fuel expenditure by income decile, and you'll see the poorest and most affected, essentially. And if you look at the effects of energy and food price inflation, it will hit the poor the hardest, and they will have to now spend an increasing proportion of their income on basic necessities, food and energy, and that is a recipe for social unrest.
We were talking about that last week, weren't we, Keith? If you take the overall level of savings, then the increase in fuel and energy prices is fairly insignificant, but those savings are concentrated up in the right-hand deciles of this graph and not the left-hand deciles. So the effect is disproportionately upon the poor.
Yep. Now, this is very interesting, and thank you very much to our Discord member, Simon W., who taught me how to correctly interpret this chart. Okay, so this is German installed power generation capacity, and that's different from actual power generation because obviously solar only works for about 14 hours a day. And so what it shows is over the last 10 years, there has been a big increase in German renewable capacity, but they have not managed to retire much fossil fuel generating capacity, because when the wind don't blow and the sun don't shine, you need to turn on all the dirty brown stuff, burning coal and lignite. And frankly, that's exactly what is happening right now. But you need to have spent a great deal of money installing all the renewables and then maintaining your backup fossil fuel system. And that means your whole energy system is getting more expensive.
So what's happening here is that those large SUVs that we all love, I don't drive one, and it's the big black Audis and Porsche. Sorry, I'm being personal here. Those SUVs that people love to buy and their big diesel engines are very fuel inefficient, and the good citizens who are buying electric vehicles and doing the right thing, their contribution towards saving reducing carbon emissions are being completely offset by other people buying large gas guzzling SUVs.
See, one of the things that strikes me about modern British culture, Richard, is that we have this individual culture where we have to respect other people's choices. And so we're not allowed to criticize people for, choosing an SUV, but we're allowed to criticize big impersonal corporations for producing lots of oil and gas. Yes. And so when you turn on Radio 4, it's full of non-stop diatribes against Shell and BP for producing this oil and gas. But nobody's ever criticizes people for buying an SUV. And right where I am in North London, the number of those big Porsche 4x4s have gotten their name now. Is
it the Macron? Unfortunately, when I see one of those, I always think it's an unfortunate choice of name. But
right, yeah. Anyway, moving swiftly on. Right, a very strong week in equity markets. Frankly, markets do not seem to be put off by the rise in energy prices, and the fact that the US non-farm payrolls came in sort of Goldilocks scenario, not too strong, not too weak, was catnip to the equity market. So all share was up 2.1%, stocks Europe up 2.3%, S&P was up 0.9%, and NASDAQ was strong, up 1.2%. Japanese topics bounced back from its drop last week, up 3.2%. Bitcoin, Richard, up 9%. And sterling regained 0.9% against the dollar. So we are in a tightening cycle, albeit a very, very slow one, it would seem. And what this chart shows, that actually equity markets generally don't have anything to fear in a rates tightening cycle, and they continue to do well despite the fall in PE ratios, which we have covered previously.
Bitcoin has had a very positive couple of weeks, hasn't it? And it's bounced strongly from the $40,000 level up to $57,000. And I think that my personal view is that it's going to go a lot higher from here before it falls back down. And I think that there has been some tremors in the market, obviously in terms of inflation and store of value. And some people think that Bitcoin is a store of value. Long-term viewers will know that I don't particularly subscribe to that view, but I do favor Ethereum because of its functionality in sort of transactional-based blockchain activity. And so I think that's what's driving it. I think Ethereum is being driven partly by the rise in Bitcoin, but also I think it continues to be supported by its utility in NFT tokens and that type of blockchain development. But I do think they've got quite a long way to go. So this is showing that the flow into Bitcoin funds, including ETFs, peaked in January 2021, which was where we actually had the peak in the price of Bitcoin, and then it sort of dropped back down to zero. It went a little bit below zero, and now it is just working its way back up. And that also suggests that if that trend continues, the price of Bitcoin will continue to go up because of supply and demand issues.
Well, it shows that people buy Bitcoin as a speculative asset. They fund into ETFs, turn positive when the Bitcoin price turns up. Number go up.
Yeah, I mean, I think, and that's true of many assets, isn't it, Keith? I mean, I think that's true of gold, although gold is notionally a store of value. People buy it when they think it's going up. So, but I mean, I'm not arguing, I'm actually not arguing the case for Bitcoin in the sense that I do think that the Ethereum has a practical use that Bitcoin doesn't have. But I think everyone has to make up their own mind on that and invest accordingly.
Yes. You know where I stand. Anyway,
I know where you stand, Keith. Yes.
Okay, so moving on to commodities, and it was another corking week in the industrial commodities space. Aluminium up 8.1%, cobalt up 5.5%, copper up 8.7%, chromium up 8.9%, iron ore, even iron ore had a little bit of a bounce, up 2.7%, although as you'll see when I show you the charts, it's kind of fading again. Lithium carbonate has had an absolutely amazing run and came off the peak, but it's been quite a peak. Neodymium has begun to rise again, up 1.8%. Nickel had a bounce, up 5.8%. Tin is at very high levels, up 3%. I'll show you a chart. Is it at all-time highs? I think it's very close. Ferrovanadium, like iron ore, is weak and continued to drift off. WTI, the crude oil future, that closed above $80 for the first time in years, up 3.3% on the week. And sadly, Dutch natural gas futures came off their lows and bounced back a further 6.2%. So heading back towards highs. Coal continued strong, up 5.6%. And Richard is right. And uranium shot back up. I was expecting it to go down. Let's show you some charts. So this is the industrial materials index, and it is heading towards all-time highs. And that's input price inflation coming down the pipe.
Yeah. And
our metals prices are rising quickly, but they're nowhere near all-time highs. The high energy costs in Europe are going to feed through to high metals prices, because a lot of metals essentially require huge amounts of energy to make them. So Nyrstar, one of the world's largest producers of zinc, is shutting down 50% of its production in Europe due to soaring energy costs. And unsurprisingly, the zinc price shot up. So crude oil had a strong week. And this chart shows that in the US, transportation consumption of fuel has fully recovered to its pre-pandemic levels. But energy equities continue to massively underperform crude oil. And
this has to be, Keith, because people are thinking the price rising crude is temporary and it's going to come back down.
Yeah, well, I just wonder actually, Richard, whether institutions are never going to come back to the energy space.
Possibly so. I mean, maybe they're also selling down holdings that they've got, so they can't be criticised. So that would jibe with what's going on here, the price action.
And if you adjust crude oil by inflation, you'll see that actually it's not terribly elevated by historic standards. It needs to double to get anywhere close to its peak in 2008. Aluminium is shooting for the moon, unsurprisingly, because aluminium is congealed electricity. And as electricity prices spike, and the blue line here is 1 month baseload power cost for an aluminium smelter in Germany. So the aluminium price has to rise. Cobalt, after a pause, has resumed its rise. Copper has leapt towards the top of its trading range, up strongly on the week. And these are Goldman Sachs's estimates of copper inventories and the path thereof. And they're saying that we are consuming copper stocks, and that is very bullish for the copper price.
Yeah.
The mystifying bull market in chromium continues. Iron ore had a bounce off its lows, where it doesn't seem it can sustain that. Lithium has had a fantastic rise and seems to have caught a near-term peak. Neodymium has had a little rise up this week. Nickel is resuming its uptrend. Tin. This chart goes back to 1974. Tin's at an all-time high. Ferrovanadium drifting off with the steel price. You know, the European energy crisis is not going away. And so Dutch natural gas futures rose again on the week, sadly. But there's an article on Bloomberg saying that Gazprom are busy restocking the Russian domestic gas stockpiles, and they should be finished doing that by the 1st of November, when they can increase exports to Europe again. So is that light at the end of the tunnel? This is European industrial gas consumption. And you see that it has declined in the last few weeks, unsurprisingly, i.e. high gas prices are causing demand destruction. And you've seen that, for example, in the zinc production.
Yeah.
Now, coal has resumed its climb, and actually in China, Chinese coal futures were up 30% on the week. So China also has a big energy crisis. And in India, coal stocks are down to 3 days for Indian power stations.
That is extraordinary, Keith. I mean, that's not far off having to cut power supplies.
Yeah. And here you really see how, you know, too much virtue signaling is really counterproductive, because when it comes to an energy crunch, suddenly everyone turns to fossil fuels. If we'd actually planned for the energy transition in a rational fashion and kept the storage open, then we wouldn't have to be burning so much coal now. Even the UK is burning coal because we've failed to store enough natural gas.
And also we've had this issue, haven't we, where environmentalists have said, we don't want nuclear energy, we don't want fossil fuels. And people have kowtowed to them, in my view. And actually, fundamentally, you don't want fossil fuels. You have, where we are, where the world is, the technology of the world is, you have to have nuclear power if you don't have fossil power, or you go back to the 1900s from an economic point of view, from an energy consumption point of view. And you can't have it both ways. And for too many years, politicians have worked on the basis you can have it both ways. And the chicken's coming home to roost now. We need to get rid of carbon production, and we need energy.
Yeah. But the thing is, what's really struck me so far about the debate in the UK, Richard, is how absolutely nobody is changing the terms of the debate. So it's still very much energy transition and actually trying to alleviate the symptoms of this energy crunch without dealing with the underlying causes.
Yeah.
Which suggests it could all happen again next year.
It does. This is the chart of uranium. And one of the reasons it perked up this week is because Macron was saying small nuclear reactors will be providing a significant amount of French electricity by 2030. Well, he may be right, or he may be out in his timing, but clearly the principle behind it is nuclear power has to be one of the elements of our current energy strategy to get us out of this mess.
Yeah.
And also, I think someone has put in a request to the EU confirm that uranium, or include your nuclear power as a sustainable form of energy production, which currently it isn't. So Japan is going to restart its nuclear power plants to cut CO2 emissions, not because of high natural gas prices. And I mean, one just hopes that because they had huge management failings with TEPCO, and Fukushima, and one just hopes that they've overcome those management failings, because that obviously is the big risk of nuclear power. If you don't have proper high quality management, it is very dangerous.
Okay, moving on to precious metals, and actually generally a positive week. So gold up 1.8%, silver up 3.8%, platinum up 6.4%, rhodium sadly didn't join the party, down 2.1%, and palladium, the winner, up 6.5%. So this is gold, which is very disappointing. Silver, even more disappointing. Platinum has had a bit of a bounce, but we're really waiting for car production lines to come fully back on before we see a sustained bull market in the PGMs. Rhodium going nowhere fast. Palladium also had a bit of a bounce. And finally, rates. And the bond market continues to absolutely mystify me when we're seeing elevated inflation everywhere, and above all, elevated inflationary pressures building that looked like sustained inflation for a long time. So wages are rising, and you're seeing a wage price spiral developing, frankly, particularly when inflation is higher than even elevated wage rates. So, but despite all that, bond yields fell. So bond yields fell across the curve in the UK and actually in the US. So
well, they're captive to the central banks, aren't they?
Yeah.
Keith? I mean, I really think they are captive to the central banks. And when the central banks lose control of it, if they lose control of it, I don't know. But at the moment, they have control over the interest rates.
So if you want to lend your money to the British government, they will give you a yield of 1.3% when CPI is what? 5.2? No, it's at 4, isn't it? RPI is 5.2. Still,
it's a deal anyway, Keith. Whatever way you look at it. Or is it a steal?
Yes, exactly. Now in the Eurozone, now this is interesting. So yields in the UK fell over the week, and in Italy and Spain, they also fell. But in Greece, they rose. So something to watch over the coming months. And this is the UK 10-year, which has been rising quickly and then mystifyingly actually fell last week, as there are some vague noises about bringing rate rises forwards in the UK, which just goes to show that the hold that central banks have over the bond market with words rather than actions.
It's totally wrong, Keith. I fundamentally think it's completely wrong that the markets, the economies operate on the basis of the words of the central bankers.
Yeah.
It's an abrogation of responsibility by politicians. Not that our politicians are great.
Yeah, well, we don't want rates to rise too quickly. So if you're one of the still buying UK 30 years, good for you. Please keep on doing it. So this is US 10-year. And again, the recent rise has stalled. And finally, the seasonality chart. So it's predicting a difficult week next week, Richard. And then a bounce back going into November and a strong rise.
Yeah, so I can see that too.
Right. And what did you get up to during the week?
Thank you, Keith. I had another one of those very quiet weeks where I didn't buy or sell anything. I had a moderately good week and up 1.2%. My change for the year is 11.4%. Yeah, I mean, I didn't really do very much. I am continually disappointed by my gold mining shares, I have to say. And if capitulation is finally me giving up and selling them, then the market is close to capitulation. But if it's just another fall washed out, then which is much more likely if I were to sell them, I would look back a few weeks later and regret. So I'm mulling over what to do with those. A lot of categories of equities are doing very well in the commodity space, and my gold mining shares are languishing, and I don't like watching that happening. So, but I sort of stick there. I'll stop rambling. How did you do, Keith?
Okay, thank you, Richard. Well, I had another good week. although
Well
in many
done.
respects, actually quite a disappointing week. I will go into this. So I was actually up a surprising 2.9%, which takes me up to 15.4% in the year, and beating
Very
your
good,
share.
Keith. Well done.
Thank you. So it's a difficult first half of the year, but my bet is finally coming off. Now, I didn't know sales, but regular viewers will know that I sold some M&G and other stuff the last few weeks, and I've been buying it. And so I've been investing that money. And during this week, I bought some of my losers. Now, the advice is don't buy your losers. Losers buy losers. But I'm mystified by the continued underperformance of oil service companies. I'll show you some charts in a minute. It's as though the market is not expecting any recovery in oil and gas investment, and I just don't think that's possible. I think if we're not going to have a continual energy crisis, we need to increase our investment in oil and gas. So I bought more Wood Group, more James Fisher, which actually is a diversified marine engineering company with exposure to the whole marine sector, not just oil and gas, but also renewables, and Hunting, which has been very disappointing. So let's talk about some companies which had big news this week. So number one was Diversified Energy. And Bloomberg came out with a report talking about Diversified Energy's enormous catalog of small gas wells in the US and how many of them were neglected and leaking methane. And they sent a report around with a methane detection camera, and the results weren't very edifying, frankly. There were a lot of these fields were steadily leaking gas, and methane is a much more powerful greenhouse gas than carbon dioxide. And so that was not good. And there was a 25% sell off in the share price that day. And the company came out with a rebuttal, but they didn't essentially say they were going to systematically correct these leaking wells. And given that they had said that it only cost about $300 to fix each one, surely that is quite a cheap fix. And if they don't get it right, then the regulators could step in and close down, essentially withdraw their license to operate. So you hope that Diversified Energy get their act together and start fixing some of these wells rather than actually just talking about it. But the yield is very good. And the alternative, of course, is that Diversified Energy had not bought these wells and they'd been left with lots of smaller companies neglecting them. Then the leaks could even be worse. But they have to get control of the narrative. And moving on to Portfolios Matters problem child, Rambler Metals and Mining, and we had a blip up in the steady decline of each company's share price this week as Rambler secured a loan, a short-term loan until they get their new gen financing done. And that loan was 50% from new gen, which means new gen must be pretty confident that this deal will finally go through. The market took that well. So hopefully that is the beginning of a turnaround in the company's fortunes. And you've seen the copper price. If they can get this right, there remains a big opportunity at Rambler. And I'm looking to buy more, but I'm not going to until they get the financing operation, actually. Okay, moving on to some oil service companies. And you'll see this is James Fisher, which I bought, sadly, around here and has been relentlessly bad news ever since I bought it. Now, prior to the financial crisis, the COVID epidemic, the share price was steadily above £20. And the marine market in general is recovering strongly. There are lots of, container ships moving around the world, and LNG, and that so James Fisher have a specialist division that works in ship to ship LNG transfer. All of that is growing strongly, and you'd expect James Fisher's revenues to start recovering soon, but so far they haven't very well, and so the share prices continue to drift off. And I bought more this week at £8, and I'm immediately down on it. Wood Group is a diversified energy consultancy and engineer, which is tilting now away from oil and gas towards renewables, but again, really not covered much from its pandemic lows, and sadly I'm again down on this one, but have been adding to it. And finally, Hunting, and the rig count in the US has been rising, but Hunting's share price has been going absolutely nowhere. And I really like the company, and we did a share talk on it, and I remain very positive, so I've been buying more. And that's it. So thank you all for watching. Thank you in particular to our donors who have helped fund the podcast and keep it going. And please, can you press like and subscribe to the channel? And in the meantime, it is goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only, and should not be relied upon for making a business, legal, or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website, or to any information, products, services, or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.